Okay, so let's do the final week. Like we said, it's a 4 week case study, even though this is the fifth week. We came to what was going to be the final session last week and put together all the raw data. So all the data we collected from an automatic system and then put together some systems and outlines some systems with some indicators that we added into it. And then finally, we're just going to go through the drawdown and a few things in regards to position sizing. So we just left that for this week. So I don't know if any guys had a bit of a chance to think about it. If you had any questions about some of the systems that we put together, we'll quickly go back over that and touch on that briefly. But tonight, what it's all about is drawdown and position sizing. You can see down in the bottom here. But when we first started out this 12-month process, which we're progressing through, the real basis of it is creating a complete trading system. And we talked a lot of things about risk models, money management being a big part of creating a complete trading system, rather than just having a system with a particular trade that you take. It's got to be a lot more detailed than that, and that's where sort of the confidence to be able to move ahead in the contracts and the belief and all that comes from when you create a complete trading strategy, and that's what sort of these five things is what makes up an absolute complete strategy. So, last few weeks or especially last week, we spoke about reliability, strike rate, expectancy, and frequency, and really concentrated on sort of what the system did day by day. Today is more about, and this is something that I put a lot of time and effort into, and really interests me. At the end of the day, it all comes back to the drawdown, which basically summed up is just what sort of losing streak is the system capable of having. And it comes back to your sort of core attitudes of how do you want to approach trading. There's many sort of different systems out there, many great systems, but some of them have bigger drawdowns than others because of the way they trade. And I know for a fact within this, when we go back, I'll sort of bring up the systems down actually. So remembering last week, we got to the raw data, so the projection catch up. We got the raw data and put together basically 11 different systems. And all those systems just picked out the ones highlighted in blue, the five of the better systems. You can see there the column expectancy, frequency, and points. So really concentrated last week on these systems in regards to how good they do with expectancy, how often frequency. So are they taking in, are we getting enough trades from it? We want something that's going to have a fair few regular trades, because at the end of the day, expectancy times frequency is what's going to give you a return on investment. So that was just, we were able to have a quick look at that, and we could see straight up that some systems really start to stand out. The PowerPoint system stands out well with nearly 70 points. And another couple of ones that stood out was the other PowerPoint one where we applied the average daily range indicator to it. So we just took it on days where the market was moving a certain distance, and that really increased the expectancy. And then these other ones down the bottom here, they're the ones that have a trailing stop attached to them. So these are the ones that will be interesting in regards to drawdown, because they have some profit targets, variable profit targets. So as a result, we're going to have some big winning trades, but also some bigger losing streaks as well. So that's what we want to do tonight, is have a look at the other side of the system in regards to drawdown and how you do that, and then how that affects your position sizing. So we'll do that now. Alright, so let's bring it up now. Where is it? Okay, here it is. So drawdown, it's a really important part of trading. I know we speak about it quite a bit, and how it's really a part of trading that's so underutilized. I mean, all parts of risk model development that we've talked about, as far as expectancy and frequency and all those sort of things, typically get underutilized. But then even more underutilized, I think, is the drawdown side of things. It's something that it took me a long time to come across. I hadn't really had people talk to me much about it before. and then all of a sudden started looking into it and understanding more about it and realised it was probably one of the most important things about trading. The thing is, you can have some fantastic trading models, but some of them are going to experience some real patches of drawdown, and unless you sort of preempt what could be coming, and base your position sizing and the number of contracts that you trade on what could potentially happen as in regards to losing streak, then you're going to find yourself in trouble if you don't sort of start doing that thing. We spoke a little bit about that last week, how some of these systems, you're onto a winning system and there's no problems as far as it creating profit within a year. But you might come across some losing streaks, or you might have just upped your contracts just as you come to a losing streak. If you're sort of not aware of that sort of thing, you might abandon ship or leave the system behind, even though it's a well-functioning system that can produce the results. But unless you sort of really understand drawdown, it's going to be tough at times. And the flip side of that too is if you do understand drawdown, it's sort of you're already expecting the worst, or you're already operating from a worst case scenario and basing everything you do on a worst case scenario. So it puts your mindset and your headspace in a lot better space when you start coming across losing trades. So what we got here, just to sort of outline this bit of a table, right up the top written in grey is the systems. So as I scroll across, there's five. Oh, I've got more systems there. 1, 2, 3, 4, 5, 6. This must be some more work I'm starting to do over here. But we've got basically 6 different systems there, but 5 I want to look at here. So across the top in each sort of little section of systems, you've got like just the net points and the gross points. So we're not too worried about the gross points, but I'm really interested in the gross points. So that's obviously after commission, the R value. So what, in regards to your risk, did you make or lose? And then we got some monthly R's. So what kind of R did it take per month? And then sort of down in these extra couple of columns, what we're going to do is go through the losing streaks. Now, I'm open if you guys have got any better way of doing this, but what I was trying to figure out the best way to calculate losing streaks, and all I could really figure was to manually sort of go through, and as you go through, see some of the sort of worst losing patches, sort of highlight it. Then when you get to the end of it, if you can see there, I've just put my cursor on it, and up here is the formula, basically just sum of that particular losing area. Now, I tried a few other things to make it a little bit more automatic, because a lot of the other things we do is quite automatic, but I couldn't think of any other way to really look at drawdown, and I just found the best way was to simply just go through and highlight those worst losing patches. And it's not necessarily just counting your worst losing streak, going, okay, where's my physically worst number of losing trades in a row? Because as you can see, this particular losing streak here, there's some winning trades in it, but if you sort of move forward, you see this particular one here, it's only a very small win. There's a couple of bigger losers again, and then another win, and sort of that win is cancelled by the next 2 losers. Then there's some more losers after that. So that losing streak really, as far as calculating a net losing streak, continues, and you sort of want to really calculate what your worst losing streak is, or the real. Make sure you get the entire losing streak in there, rather than just going through and looking for, sort of counting out, looking for your worst patch of red figures. And make sure you look at the entire period of time that you're looking at and calculate your worst. So if I sort of just go through this first one here, you can see there's a losing streak there. Then sort of we get a return, or work in this column here. This is the points column here. So there's a 56 point winner there. So that's a big winner. So obviously that's going to end the losing streak there. And sort of scrolling through it again, just looking at worst losing streaks, and at the bottom of each losing streak, I've just calculated in R values what it was. So this one was a 13 R value streak. This was a 10 R value losing streak. Then I've got a couple of columns because sometimes, like, I didn't know whether this, if you sort of just look at the main patch, the losing streak, is that worse, or is it, if I include this bit back here, is that worse? And I did all sorts of, this area here got quite patchy, so I ran figures in all sorts of different areas as far as coming up with the worst losing streak, and in the end it was all not that bad. I think the worst it was about 9R. think that was worse than up here. 10 hours worse up here. But then it all didn't matter because right at the end of the year, in fact, most of them had their worst losing streaks towards the end of the year. September, sort of October was a bit of a tougher time to trade. This one had its worst losing streak by far, right in this little patch here. When you add it all up, it added up to a 27R losing streak. So does that make sense just before I move on, how I've sort of calculated that as far as just your raw data into getting what your losing streaks could possibly be? Yeah. Yeah, so then it's just a matter of taking that information, working out, how's that, how's that benefit me, and how's that going to help you? So you can see if all you did was month by month, look at it. See, it's not quite enough just to look at it month by month. You could just, like when we were looking at the systems last week, we could see sort of when the better months and the worst months. And if all we did that, you can see there negative 4R, negative 1R, plus 4R, plus 15R, plus 5R, plus 4R, plus 7R, negative 10R, negative plus 22R. It doesn't give you your worst. There's a lot worse than that. So just looking at it month by month, I mean that's a good start. But I'd be much more inclined if you want to get a complete understanding of what your potential drawdown is, to make sure you go through and just manually find your worst losing streaks. Like I said, there could be some sort of formula to come up with to make it a little bit easier, but I'm not so sure. I couldn't really think of anything, and I just had to go through it manually and find that out. So anyway, we've got our worst losing streak. So down the bottom here, I've just sort of boxed it all up, make it nice and easy to see. So worst streak, there it is, 27R. So we also want to put it in points to make it a little bit more easier to understand. I don't know whether you guys think of your losers or your winners in R, or whether you still think of it in points. I mean, some might do an R, some might do it in points, so we'll do it both. So this is just the same figure, just displayed different ways. So this one we can see 33 points of a losing streak. That's including commission, including commission added onto it. So it covers the complete picture. So what I do then is just take that figure and you divide it into your net, or sorry, your gross figure for the year. So this particular system made, and I'll highlight it there, 54.6 points. Okay, 54.6 points, but it had a losing streak of 33 points. So now you can start to see straight up that even though this is a really good system, makes a lot of points, it's got a losing streak, and then you can work out a percentage. 33 into 54 goes about a 62%, meaning 62% of what you make I'll rephrase that again. You still make 54 points. I want to make it very clear that this system makes 54 points at the end of the 10-month period that we've looked at here, no doubt about that. But in there's a losing streak that's the 62% of what you make. Is that sort of clear on how I've displayed it there? So that 62%, I want to have a figure there that makes it so that straight up you can just go, okay, I can see what the drawdown and the effects on this type of system are. Okay, if all I did was say 33 points as a drawdown, well, it doesn't sort of mean too much. If you made 150 points, well, that's not really an issue. If you made 20 points, it's a big issue. If you made 54 points, like we have here on this system, it's not an issue, but it could be for some. For me, like we talked about last week, 62% is way too high for me. But that's only because I very much emphasise keeping my drawdown to a minimum. But that's just, that's an objective of mine as a trader. Someone else, it might not be so much an issue. Okay, so now we can start to go through and have a look at these systems in regards to drawdown. So hopefully you guys can see how I've calculated that, and just with your own systems now. So remember, the point of this is to take it and make it usable for yourselves, and make a real example of drawdown and why it's so important. So if you can apply it to your own systems, even if you've got a system that's, obviously these are quite automatic systems, so it's very easy to calculate the figures. So if you've got something a little bit more discretional, What it involves is just recording all your information as you forward and forward test, and just collect that information. And the more information you collect, the better off you're going to be, and start to work out how your drawdown is impacting your system. So moving along, so you can see I won't go through all the different information, but you can see up the top here the name of each of the different systems and the drawdown. And so like we did last week, we add in a few indicators such as the daily range indicator and the gap indicator. I know you weren't here last week, Rog, but what we did is we took some raw information and just added a few indicators to it. So a daily range indicator is just something that indicates sort of what type of movement we're getting in the market. So for faster moving or wider moving markets, we apply certain systems, and when it's tighter, we apply different systems, and sort of just start to look at the type of market we've got and try and apply the right systems to it. So by doing a few things like that, we could start to really increase the value of the system, as in get better returns on our investment, and at the same time reduce the effect of drawdown. So we want to keep drawdown as low as possible, and expectancy and frequency and return on investment as high as possible. It's the ultimate combination of all those areas that we're talking about right at the start, as far as what makes up a risk model. Those things there. Projection catches up. Those things there. So we just look at the next system. So the second power fade system with a trailing stop or a trailing profit target. And if all we did was add the gap indicator, so that means the gap where overnight the gap was smaller than 5 points, because what happens is when the gap's smaller than 5 points, that means it hasn't moved much overnight, and it's got more chance of actually doing its trend during the cash market. So when we're looking for a trend following system like we have with this one, if you guys remember the second power fade with the trailing stop, we're looking to pick up on big trends just by adding the gap indicator and taking these trades when just on the days when the gap overnight was less than 5 points, it dramatically reduces the effect of drawdown. See, it goes from a 62% to a 28% situation. Yet the points are exactly the same. In fact, the points are a little bit better. So we've increased return on investment and we've decreased drawdown. So that's sort of the ultimate result that you want from adding some indicators. Obviously, frequency dropped as well, but I mean, at the end of the day, frequency doesn't really matter. Frequency is halved. And you can see frequency is written in green here. So in this particular case, 204 trades. This one, 109 trades. But as long as expectancy is sticking up and return on investment is still right up there, I mean, frequency really doesn't matter. If all of a sudden frequency really drops and then you see the return on investment drop, well then that's sort of a little bit of an issue. But so straight up, by adding a little indicator like that, you can dramatically decrease the effect of drawdown. So that would, to me, be a lot better way to approach that particular system. I know that's and this is a lot of the system idea was straight from UCAF, and this is something you came up with. So is that something that you'd use? You think sort of a gap indicator or something like that to sort of smooth out your equity curve? Yeah, of course. I didn't think too much about the gap. I applied a few things as to why I think it would work, and normally when you see a lot of movement in the pre-market, quite often you'll see just a sideways start to the cash market. It's just I don't know, it just seems to happen. So I just thought something like this. We want a small gap overnight, so just apply an indicator, then it works. It's all about, like we said last week, trial and error, and it's like this page here, the research and development page. when the projector catches up. It's a bit slow tonight. It's about trialing a whole heap of different things. A lot of things worked and a lot of things didn't work. It's just taking the ones that do work and then just working with them. So just scrolling along a little bit. So again, the same system, second power fade, trailing stop, but when it's above an ADR of 14, so meaning when it has an average daily range of above 14. So you can see frequency here is 73. So that it drops a fair bit, the frequency, but expectancy is still high. It's still up over 40 points, so which is not too bad, but still drawdown is really starting to drop. So obviously with something like this, when you're looking for, it's a trend following system. When you've got markets that are moving, wider moving markets, it's a lot more prone for that. So I mean, just straight up, when you think about it in your mind, you think, yeah, of course drawdown should dramatically drop. As a result, the points have dropped a little bit as well. Return on investment has dropped a little bit because we're taking a whole heap less trades. So that's a result of frequency dropping, return on investment drops, but dramatic drop in drawdown, which is what the most important thing. Sort of keep on moving along through them. The next one here, second power fade. So again with the trailing stop, so taking that particular system when the average daily range is above 14. So utilizing this system, so 73 trades were taken with the trailing stop systems, and then when it's under a daily range of 14, using the PowerPoint trade with just a fixed 8 tick profit target. So thing about this is, and you got to compare it with the original system. So if you remember, the original system was 54 points and 62 drawdown. So this one, 62 points. So we've had about a 15-20% increase in ROI, or return on investment, and drawdown has come down to 26%. So drawdown has literally gone to about a third of what it was. So there we go. It's just a few little things if you just think outside the box to do to make the system work better. And it's but you've got to display it in all the different fashions. So you've got to look at it from a return on investment side, which we did last week. That's we looked at all the systems, added a few things, we saw what happened to frequency, we saw what happened to expectancy. But that's just not, that's only sort of half the picture. Now what we're doing today is really looking at it from a drawdown perspective and finding what you prefer as a trader based on drawdown. Kath, so with that, so this one we're just talking about now, yeah, you're taking first PowerPoint or second, yeah, this one, yeah. So you can see, so frequency is 204. So what it's doing, it's taking a trade every single day. But what it's using is, so remember the average daily range indicator, okay, and found that 14 was really quite a nice balance for it. So when it's got an average daily range of 14 or more, which works out to be about a third of the year, it does that. Apply the trailing stop, the second power fade with the trailing stop, so your system, when it's above 14. But when it's below 14, which is about 2/3 of the year, apply the first PowerPoint strategy, where you just take the first PowerPoint and go for a fixed target of 8 ticks. Got it, cool. And then I must, oh yeah. And then the final two systems, having a look at the PowerPoint system. So the first PowerPoint system, I didn't what I should have done is just worked it out for, I don't think I have done it, no, worked it out for when it's just the first PowerPoint as is, maybe on 8 ticks or something like that. But what we would have found is the drawdown for this first PowerPoint system is not really that bad. Doesn't matter whichever way we looked at it. So we did a few things and worked out a few things just to increase the return on investment and increase the expectancy and things like that. So drawdown doesn't really impact these ones, so it's not so much of an issue. It's a big issue with the trend following stuff. With this, because of the fact it's going for fixed profit targets, it doesn't have as great of a losing streaks, but it still matters to work it all out, and you know, whenever we can reduce it, great. But it's still definitely worth looking at. But in this particular case, that first PowerPoint system with the two different types of fixed exits, so having an 8-tick exit when it's in its tighter moving market, and when it's over that average data range of 14 in those faster moving markets, going at a 15-tick profit target. So 69 ticks for the year, but with a losing streak of 14%. So 7R or 9 points was its worst losing streak. So a really good performer in regards to drawdown. And then you can see the next system. Basically, this one here is just a smaller version of the original. All it is just taking the trades when the average data range is above 14, just going for those bigger profit targets. So expectancy is really high because it's taking a lot less trades, still getting pretty good points. Drawdown's jumped a little bit; it's gone from 14 to 20. And you can see that, but there why that is, because as soon as you start going for bigger profit targets, your strike rate's got to drop a little bit, because it's just automatic. That's automatically what happens. It's that balance between, do you go for higher strike rate and less profit, or do you go for more profit and a lower strike rate? There's just that balance. And as soon as you start going for bigger trades, automatically that drawdown effect starts to come into play, and it starts to increase. And that's all that's happened there. But yeah, so that guys is the the effect of drawdown, and how important it really is, and just like what we looked at last week, there's a lot of things you can do just straight up just to reduce it, and it just all comes back to trial and error. And it sort of comes back to, then from there, once you understand the drawdown side of things, it's all about plugging it into a formula. So if you remember when we just went through the creating a risk models, or creating risk model systems, when we were just looking at the theory side of it, you take your worst drawdown and you really should double it, because you always want to work from a worst case scenario, because what could be coming is a worse losing streak, no doubt about that. So we don't want to base anything on the current worst losing streak, because it could be worse. So sort of if we want to even cover all our bases in regards to that, I'm a big believer of just doubling your worst losing streak. So I do that, I double it and go, okay, I expect, well, don't expect, but I've got myself covered for a situation where the worst losing streak is twice as bad as my one that or my current worst losing streak, if that makes sense. So, for example, if you were to, let's just look at one a bit more specifically. This one here, where we took the second power play with the trailing stop when it's above 14, average data range of 14, then taking the PowerPoint when it's below a certain range, so really blending the two together. So if 26% is its worst losing streak, well, I'd be looking to double that and say it could get up to a situation where it can have a losing streak of 50% of what it can make. And then from that, you use the position sizing formulas to work out what sort of contracts you should be trading. So won't go into that now. Sort of sit down and work it all out. If you go back and review the sort of position sizing formula and work it out. So what you've got to decide beforehand is what. So if you imagine your account, if you've got a $10,000 account, how much of that $10,000 account are you prepared to risk? Okay, so the more you're prepared to risk, the greater that you're going to make. So if you're prepared to risk $2,000 and someone else is prepared to risk $1,000, well, the person that's prepared to risk $2,000 has a lot higher percentage of, or sorry, will make a lot higher return if they can handle the risk that they're putting out there, because obviously they're going to have there's more room for movement as far as risk, therefore they can trade higher contracts. But now that you start to understand what your worst losing streak is, so in this particular case it's 16 points, you double it, it's actually 32 points. Well, you go, okay, if I'm trading two contracts, $125 is a 5-tick risk. Okay, then you divide that into 32 points. So I hope you guys are with me here. So roughly, yeah, so a quarter, 1.25 points is like $125 risk, and you multiply that by 32. So it gives you roughly, I'm just talking really roughly here, about 4,000. I think it works out to be there. So out of a 10, sorry, I got myself confused here. Hopefully you guys know the point I'm trying to make is you can work out, once you know your worst losing streak, you can work out what type of situation you're in as far as what type of money you could lose. So if so far 16 points was your worst losing amount, base it on 32 points. Okay, go. I have a possibility that I will lose 32 points within my trading system. Now, based on however many contracts you're trading, you can then work out and figure out your dollar drawdown of what that could be. So not only are you working out your percentage drawdown, but also work out your dollar drawdown. Does that make sense? I know I made a bit of a meal of it in the center there, but do you sort of pick up what I'm putting down there in regards to working out a percentage drawdown and a dollar drawdown? And what that comes back is working out your position sizing. Yeah? Okay, cool. It's very important. Very, very important. And that's what we talked about at the beginning. It's sort of preempting what could happen and already dealing with it. So let's say like we worked it out and out of your $10,000 account, there's a possibility of having a $3,000 losing streak. Once you've doubled your worst losing streak, you work out to be $3,000. Well, you can imagine how you feel as a trader if you've already dealt with the situation and understand that you've got a possibility of losing $3,000. It's not an issue compared to someone that hasn't worked that information out, and all of a sudden they start to lose this money and they get more and more edgy. The more and more they lose, and they start getting right to the maximum of their losing streak. Just before they end the losing streak, they bail out because it's too much for them. But you guys have already understood the sort of the consequences or the entire relationship that's involved with you taking these trades, and you've already dealt with it. So for that reason, you can move forward. So hopefully you can use that information and apply it to your own trading systems. Because once you get drawdown and position sizing, that's why I spend a lot of time on it. So passionate about it, because for me, I just think it's, if you have it all worked out, there's nothing that can really go wrong. It's sort of you've based everything on actual situations, whether it's back testing or forward testing. You've got it all worked out to strict mathematical formulas, and everything should be fine moving ahead. So we'll leave it there, guys. That's basically the end of the case study. So yeah, you just go ahead and take that information, run with it, create your own systems, apply it to the systems you already got. Hopefully you've got a real practical sense of how to use all those elements that we talked about. We've sort of covered them all now in quite a bit of detail, and applied to some real figures based on what's happened over the last 10 months. So take it and run and do well.